ये वीडियो हम बात करने वाले हैं व्हाट इज आरएचपी और डीआरएचपी का मतलब क्या होता है, उसके बारे में डिस्कशन करेंगे। और इसके बेसिस पर आप डिसाइड कर पाओगे कि आपको आईपीओ में अप्लाई करना है या नहीं करना है। आईपीओ किस पर्पस से लेके आ रही है कंपनी, उसका एंकर बुक क्या है और कंपनी की डिटेल्स सारी की सारी डीआरएचपी और आरएचपी को एनालिसिस करना हम सीखेंगे इस वीडियो में। ये जो वीडियो मैं बना रहा हूँ एजुकेशन पर्पस के लिए है। कोई भी इसमें अगर इन्वेस्टमेंट करता है इसकी और रिकमेंडेशन देख के, ठीक है, तो ऐसा ना करें, आपके फाइनेंशियल एडवाइजर से एक बार सलाह लेके उसके बाद ही इन्वेस्टमेंट करें। बाकी ये सीखने के लिए बेस्ट है। आप इसका कंसेप्ट एक बार समझ जाएंगे तो आपको आइडिया आ जाएगा किस आईपीओ में आपको अप्लाई करना है, किस आईपीओ में अप्लाई नहीं करना है, कंपनी किस पर्पज से आईपीओ लेके आ रही है, उसका सारा सारा डिटेल्स उसके आरएचपी एंड डीआरएचपी में ही होता है। तो उसको समझना मेन इम्पॉर्टेंट होता है किसी भी आईपीओ में अप्लाई करने के पहले। तो एक वेबिनार्स के थ्रू मैं आपको ये एक्सप्लेन करने जा रहा हूँ, जो कि मैंने आज अटेंड किया हुआ था वेबिनार्स। उसमें आपको सारा सारा एक्सप्लेन करके बताया जाएगा कि कोई भी कंपनी में आपको क्यों इन्वेस्टमेंट करना चाहिए और लॉन्ग टर्म वेल्थ आप किस तरह से क्रिएट कर सकते हो। सारा का सारा इस वीडियो में आपको बताया जाएगा। वीडियो में बने रहिएगा इसी तरह से।
Hello and good evening, everyone. I am Mansi Ganikar from the Investor Education Department of NISM. NISM is a capacity building initiative of SEBI. We at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in five broad areas: long and short term academic programs, certifications for market intermediaries, e learning programs, training programs for working professionals and academia, and various investor education initiatives. Today's webinar topic is the IPO life cycle, from decoding the DRHP to long term wealth creation by Aditya Jadhav. Aditya Jadhav, CFA, is an investment professional with over 15 years of experience across investment management, venture capital, private equity, and capital markets. A CFA charter holder, VGTI engineer, and MBA in finance, he has worked with organizations including SIDBI Venture Capital, Kubera Partners, and the National Stock Exchange of India, with extensive experience in evaluating businesses, investments, and public market opportunities. In this webinar, Mr. Aditya will take participants through the IPO life cycle, from decoding the DRHP and evaluating the issue to understanding business quality, valuation, risk, and long term wealth creation with practical insights from the NSE IPO journey. Now, I would request Sir to begin with the session.
Good afternoon, everyone, and welcome. Thank you for joining the NISM Investor Awareness Education webinar. My name is Aditya Jadhav. I'm a CFA charter holder and the founder of Ganbaru Advisors, a SEBI registered investment advisor. Today, we are going to spend the next 40 minutes on topic that touches almost every retail investor in India at some point of time, right? The IPO. The session is called the IPO life cycle, from decoding the DRHP to long-term wealth creation. We are not just going to talk theory, we are going to talk, or we are going to walk through two live real case studies. One is NSE, the National Stock Exchange, and Milky Mist, the dairy company. And we will apply an actual institutional style rating framework to both live in front of you. By the end of this session, you should walk away with a repeatable process you can use on any IPO that comes to market, not just these two. Before we begin, let's go for some important lines. Please read these lines carefully because everything that follows builds on top of them. First, this is purely educational. The analysis of NSE and Milky Mist you're about to see is meant to demonstrate how an IPO get analyzed. It's not a buy or sell recommendation for either company. Second, nothing here is a solicitation. I'm not offering to buy or sell securities on your behalf, and I'm absolutely not promising listing gains or future returns. Nobody can promise that, and if anyone does, that's your first red flag. Third, please get in touch with your SEBI registered investment advisor who could assess suitability for right IPO opportunities for you. Your objectives, your risk appetite, and your investment horizon, these are quite personal to you. On he can guide you on that. And finally, always verify your advisor. SEBI maintains a public database of registered investment advisors. The link and QR code are on screen. Bookmark it. This one habit alone protects you from a huge share of investment fraud in this country. With that out of the way, let's talk about how an IPO actually happens. So, what actually happens when a company decides to go public? The regulator Yes. The regulator overseeing this entire process is SEBI, and the two exchanges where shares eventually get listed are the BSE and the NSE, which interestingly is one of today's our own case studies. There are 6 stages here, and I want to walk through each one because understanding the IPO process helps you understand why certain disclosure exists in the DRHP. So let's go to the stage one first. Board approval and intermediaries. The company's board formally clears the decision to go public, and then a small army gets appointed. And this army includes a merchant banker, also called a book running lead managers, a registrar and transfer agent, and the legal counsel to guide the company in this complete process. Stage two, the actual DRHP filing. So DRHP stands for draft red herring process. This is the big one, and we are going to spend an entire slide on it shortly. The draft red herring prospectus is filed with SEBI and the stock exchanges. Think of it as the company's confession booth. Everything good and the bad about the business goes in here. Stage 3, a SEBI review. The regulator goes through the document line by line, examines the disclosure, and then raises what are called observations, essentially questions and that required clarification. This typically takes 4 to 6 weeks. Now, stage 4, the RHP and the price band. Once SEBI is satisfied and clearance has been granted by SEBI, the company files the final red herring prospectus, and this is when the price band and the issue size gets announced to the public. Stage 5, the actual bidding period. A 3-day window opens where the anchor investors, qualified institutional buyers, non-institutional investors, and retail investors like many of us submit your bids. Stage 6, actual allotment and listing. The registrar finalizes who get how many shares and the stock list on BSE and NSE. Now, 3 numbers worth remembering from this slide. The typical board to listing timeline is 6 to 9 months. So an IPO is actually a long process before you ever see it in the market or news. Since the 2023 reforms, listing now happens just T plus 3 days from the bid closes, which is remarkably fast by any global standards. And for most main board IPOs, SEBI requires a minimum 25% public float, which means at least that much of the company has to be held by the public after listing. So keep this cycle in mind because everything we discuss for the rest of the session sits somewhere in this timeline. So now let's go to the next slide. So now here is a mindset shift I want to plant early because it colors everything else today. The IPO process is the only beginning of a stock's journey, not the end goal. Look at the timeline: IPO price, the listing, 1 year, 3 year, and 5 years. Most retail investors only think about the first 2 points on this line. That's what I would call the listing gain mindset. Okay. All these individuals are completely focused purely on allotment, hype, and where the stock happens on day one. It's exciting, but it tells you almost nothing about whether you own a good business or not. Contrast that with the investment mindset, which looks at earnings, cash flows, the durability of the company's competitive moat, valuation, and how management allocates capital. And beyond that sits the wealth creation mindset, which asks, can this business sustainably reinvest its profit at higher rate of return year after year for 5 or 10 years? Today, we are going to show you very concretely why this distinction matters, because listing day performance and long term performance are often completely disconnected. So let's look at the evidence. This table is, in my view, is one of the most important slides in the complete deck. It shows 5 real companies where the listing day reaction told you almost nothing about what comes after. Start with Omnitech Engineering, which got listed in February this year at 227. On listing day, it almost fell by 10%, a weak debut by any measure. Anyone who panic sold on day one would have missed a subsequent rating of over 150%. Now let's revisit another company called Shadowfax Technologies, which got listed in January at 124 rupees and dropped over 11% on debut. Arguably the weakest listing on this table. And yet, post listing, it delivered close to 90% in gains. The listing disappointment simply did not define the stock's future. Powerica, a near flat debut, down just over a 1%, unremarkably on day one. But it went on to create a nearly 50% in value for patient investor. Now flip to the positive debut example. So take an example of Sedemac Mechatronics, which got listed up by over 7%. And unlike some flashy debut, this fades. This one kept compounding over 100% post listing. Positive debut plus genuine follow through. And finally, a name many of you will remember, right? A Honasa Consumer, the parent company of a Mama Earth, which got listed in November 23 with a modest 4% gain and has gone on to deliver a 47% return since then. The pattern across all 5 names is inconsistent. Oh, sorry, is consistent. The emotional reaction on listing day is a terrible predictor of a long-term outcomes. Some of the best forward returns came from the weakest debuts. This is exactly why we need a structured framework instead of an actual gut feel, which brings us to the next slide. Every single IPO, no matter the sector or the size, boils down to 3 questions. And I want you to internalize this because you can apply them to literally any company that comes to market. Question 1: is it a good business? This is about the quality of the underlying economics. Does the company have a genuine competitive advantage? Is the management credible? And what do the financial statements actually say once you look past the market. Question 2, is it good at this price? A good business bought at the wrong price is still a bad investment. This is where you look at what growth expectations are already baked into PE ratio, the EV by EBITDA multiple, and how the company is priced relative to its peers. Question 3, what actually can go wrong? Every business carries risk. It could be regulatory risk, a competitive risk, a customer or revenue concentration, a governance weakness, a high leverage, or a plain execution risk. And this leads to the single most important sentence in this entire presentation. A good company can still be a bad investment. Why? Write down that. A good company does not equal a good investment. We are going to prove this point twice today, one with NSE and one with a Milky Mist. If there is a one document, you should never skip before applying to an IPO, it's this document, DRHP, the draft red herring prospectus. I want to be blunt. Read it as an investor and not as a brochure the company handed you. What's actually inside it? 6 things which are worth flagging: the business model and the revenue driver. How does this company actually make money and from what or from whom? Promoters, board, auditors, and related parties. Who runs this business? Is it run by a independent board or by the promoters? Who oversees it independently? And are these transactions with related entities that deserve scrutiny? Risk factors, litigation, and contingent liabilities. This section is usually the longest and the most skipped part of the document, and it's often the most revealing. Restated financial statements and KPIs. The numbers cleaned up and standardized along with whatever key performance indicator the company wants to highlight. Objects of the issue, capital structure, and selling shareholders. Where is the money actually going and who is going to cash out? And industry data, competitors, and management discussion. The company's own narrative about where it sits in the market. Here is the usual reading rule I'll leave you with. Management tells you why the business will actually win, and the DRHP also tell you what could make it fail. So read both sides of the coin. Don't just read the glossy growth story on page 1. Read the risk factors of the DRHP and ultimately ask yourself the investor's question: are we buying a great business or are we simply buying a stock because it happens to be coming to market right now? That FOMO, the fear of missing out, is exactly what triggers framework protect you from. So how do we turn all of this information into something structured and repeatable? So we use a scorecard at 2 pillars, 5 criteria each, half a star per criteria for a maximum of 5 stars. Pillar 1 is the IPO issue itself, worth up to 2.5 stars. So we look at the issue structure, meaning the primary versus offer for sale, mix, size, and how well aligned it is. The track record and execution quality of the merchant bankers, the promoters post issue holding, which tells you how aligned they remain with the public shareholders, the object of the issue, is the money going to debt repayment, growth capex, or just cashing out selling shareholders, and finally the quality and the conviction of anchor investor who are putting money in the IPO. Now, pillar two is the company itself, allows up to 2.5 star. So here we assess promoters' background and capital allocation track record, board independence and governance oversight, the quality, tenure, and qualification of the auditor, the financial statement which comprises of growth, profitability, cash flows, and balance sheet strength, and the growth outlook of the company, the industry structure, competitive mode, and sustainability of the leadership. So add the two pillars together and you get the IPO rating. Higher stars means a structurally stronger IPO. But I want to be clear that this is a decision aid, not a recommendation. It disciplines your thinking, it doesn't replace it. Now let's actually put this scorecard to work on case study 1, which is NSE. So let's begin with the introduction of a NSE. Of course, the NSE needs no introduction to most of you. It's the exchange you have probably transacted through every time you bought a stock. This is a market infrastructure business, and what's fascinating about infrastructure business is that scale, liquidity, and regulation shape the economics in a very particular way. Look at the flywheel diagram. More participants attract more liquidity. More liquidity attracts more issuer, which in turn builds a enhanced trust, a better supervision, deeper data, and stronger operating leverage. It's a self-reinforcing loop, which is exactly what a strong moat looks like on a paper. But the key question we need to answer today is, how durable is this moat? And what price should an investor actually for this business? So let's look at a specific of the NSE IPO issue itself. First, and this is critical, this is going to be 100% offer for sale. That means a zero fresh proceeds go to the company. Every single rupee raised through this IPO goes to existing shareholders who are selling down, not into NSE's own balance sheet. The issue size is up to 149 million shares. The allocation gets split roughly along regulatory norms. Up to 50% will be reserved for QIB. At least 15% would be available for non-institutional investors like HNI, and at least 35% would be reserved for a retail investor. Excuse me. Now here is a standout data point. 19 book running lead managers were appointed, the largest ever syndicate assembled for an Indian IPO. That tells you something about the scale and complexity of this listing. Interestingly, NSE has no identifiable promoter, a confirmed regulatory classification in the DRHP. This is unusual and matters for governance, which we'll come back to later on. So up to 60% of the QIB portion may go to anchor investor. And though the anchor book itself wasn't disclosed at that time, right? But the shares are going to list on BSE. And so what's called a cross-listing arrangement. And the registrar is MUFG link time. Or earlier it was known as a link in time. So that's the issue structure. So now let's look at the scorecard. So let's run NSE through our scorecard, starting with issue and governance. So issue structure earns half a star. It's clean 100% offer for sale from investors and not promoter. So there is no issue complication. Merchant bankers earn another half a star, and frankly, this was an easy call. 19 blanks, including Kotak, JP Morgan, Citi, HSBC, and Morgan Stanley. You simply cannot assemble a syndicate like that without serious institutional confidence in the offering. Promoter holding is marked as a not applicable. Remember, NSE does not have any identifiable promoter. So this criteria doesn't apply in the traditional sense. Objects of the issue is also not applicable since this is an entirely offer for sale. So there is no capital raising objective to evaluate. Anchor investor gets a half a star based on the scale and quality of the syndicate. Even though specific anchor book composition, right, is yet to build and will get built at the time of IPO, we are assuming most of the mutual funds would apply to the anchor portion. Now flip to the company pillar. Promoter background is not applicable for the same reason. No identifiable promoter. Board independence earns a half star, and this is a genuinely strong governance signal. Of 7 out of the 12 board members are public interest directors, giving the board an independent majority. And there is a dedicated IPO committee overseeing the offer process specifically. Remember, this is 100% offer for sale, and company is not going to get any revenue out of this IPO. But still, company has got IPO committee overseeing the complete offer process. Auditors also earn half a star. NSE is audited by one of the big four and critically without any qualified opinion on the financial statement. So add it up so far. Issue is at 1.5 star. Company building towards 1 star on governance alone. So let's dig on level deeper into the governance picture before we move on to the numbers. So governance deserves its own movement here because foreign exchange, an institution that's supposed to police market integrity, governance quality is not a side issue. It's a core issue. And the governing board has a 12 members, and as I mentioned earlier, 7 are public interest directors, independent by design. The chairperson is Shri Srinivas Injeti, a IS officer, a retired IS officer, and the board includes names like retired Justice Abhilasha Kumari, former company secretary Rajesh Gopinathan, the MD, the current MD and CEO Shri Ashish Kumar Chauhan sits alongside 2 executive directors, a non-independent LIC nominated director. The IPO committee itself is predominantly made up of independent directors, a positive targeted governance signal specifically for how this offer is being run. Now the auditor caveat, and this matters. Remember, PricewaterhouseCooper, right, is a top tier by reputation. But the DRHP itself discloses emphasis of matter in the audit report, tied specifically to the SEBI co-location scam and governance and conflict of interest issue. So high quality auditor, but with a disclose and material caveat. That's exactly the kind of nuance a headline Big Four auditor rating can hide if you don't read the fine prints. On litigation against the company itself, there are total 88 matters worth roughly 2600 crores, spanning 18 criminal proceedings, 43 tax proceedings, and 6 statutory or regulatory actions, and 21 material civil matters. So subsidiary add another similar matter. And on the asset side, NSE itself is pursuing 23 criminal, 5 civil matters worth of 4,000 crores. But here is the genuinely positive development. The co-location matter has been settled. SEBI granted in principle approval for 1500 crore settlement, and NSE completed full payment by 31st July 2026. split across in two tranches. This was upgraded in status, right, from merely provided for to actually settled and paid matter. So this resolves the single largest legacy overhang on the company. What remains open is MSCI's unprovided 800 crore claim and 43 tax matter within that 2600 crore total tax liability. So net on net, governance meaningfully improved with one major overhang cleared but not a completely clean slate. So now let's move on from governance to the financial numbers. And this is where the picture gets more mixed. Revenue growth against a threshold, our threshold, an internal threshold of greater than 20% over 3 years. This is actually fails. FY26 revenue of NSE actually fell by 3% year on year against FY25. That's not a clean uptrend from FY24 through FY26. Revenue concentration risk also failed. So revenue is heavily concentrated in transaction charges and trading member concentration sits at nearly 47% in the top 10 members for FY26. EBITDA margin against a 50%, 15% threshold, a comfortable pass. NSE post a 67% reported a EBITDA margin. That's an extraordinarily profitable business model. ROE or return on net worth or return on equity against a 20% threshold, a mixed result. This is a technically pass at a 33% for FY26. But that's down sharply from 45% in FY25. That's a steepest single year decline in 3 years from 45% ROE in FY25 to 33% in FY26. Debt to equity against a less than 2x threshold. A clean pass. NSE carries nil borrowings, a genuinely debt free company, a top tier balance sheet. CFO, which is a cash from operations to EBITDA, is mixed and left unscored. So, cash from operations swung widely across the 3 years, distorted by margin money and settlement fund movements that are specific to how an exchange operates as on 31st March of each of the year. Sector position is rated strong. Of course, NSE holds 93% to 100% market shares across different products with self reinforcing is also strong. A quarter one FY27 EBITDA margin came in at a 78%, a positive subsequent event confirmation. And valuation is quite a mix. Triangulated around 1600 to 1700 per share, roughly 35 to 36 times FY28, which is actually at a discount to peer BSE, which is trading at 45 to 55 times. The picture is exceptional profitability and balance sheet strength, but stalling top line growth and concentration risk. So let's look at the trend more carefully. On screen, you can see the actual numbers behind that scorecard. Revenue moved from 148 billion in FY24 to 171 billion in FY25 before pulling back to 166 billion in FY26. EBITDA margin followed a similar arc, 67% up to 74%, again back down to 67%. PAT margins tell the same story, peaking near 55% in 25 before settling at a 51%. Okay, I guess there is some problem and people are unable to see my screen. So let me. Guys, is there any problem in my screen?
It's visible.
It's visible, right? Okay. No, some of the participants have mentioned in the comment box that they are unable to see the slides.
No, sir, no, it's clearly visible.
Okay,
Yes.
thank you. Just a minute. Yeah. Okay. So three key reads that I want you to take away from this slide, okay, which is first, that 3% revenue decline means the 3-year growth threshold simply fails, no matter how strong that margin looks. Second, return on equity compressed sharply from 45% to 33% in FY26, the steepest single year drop. Third, the balance sheet stays debt free throughout, though the cash flow from operation to EBITDA ratio remains unscored due to those margin money distortions. This is a business generating enormous profit margins on a shrinking revenue base. That combination should make you pause before assuming growth will simply resume. So let's look at where the actually revenue comes from, because this explains a lot about a growth stall. So transaction charges makes up to 78% of revenue in FY26. Still the dominant share, though it has come down slightly from 82% in FY24. The top 5 trading members contribute nearly 32% of revenue, and the top 10 contribute almost 47%, and that concentration has actually increased over the 3 years and not decreased. So here is what I find most telling: both revenue concentration and the trading member concentration are named by NSE itself as a top 10 disclosed risk factors. This isn't a analyst speculation or my assumption. It's a company acknowledge, and I would rate the severity of medium to high. On market position, NSE holds 93 to 100% market share, essentially a near monopoly in Indian exchange traded derivatives and cash equities. But much of the underlying growth data, right, comes from a Red Seer report which was commissioned by NSE itself. So treat those projections as a management adjacent rather than fully independent. Looking at NSE's own priority ordered risk list, the trading volume risk sits at number 1, followed by regulatory and enforcement risk. IT and infrastructure reliability and revenue concentration itself sits at number 5. So the structurally moat is real in the business, but growth from here needs a diversification beyond pure transactional volumes. So this slide for me is the actually crux of the NSE investment debate. First, look at the revenue mix gap between Indian exchanges and the global peers. Indian exchanges derive over 78% of revenue from transactional charges alone. Global peers, by contrast, spread revenue much more evenly. Listing fees at 5 to 10%, data and connectivity at 5 to 10%, index and data licensing about 10%, and clearing and settlement also about 10%. So the key message over here is global peers monetize a recurring non-transactional revenue far more deeply, which reduces their dependence on raw trading volume. NSE hasn't gone there yet. Second, look at the derivatives volume chart. This is NSE's moat and also its cyclical risk. The World Federation of Exchanges data shows APAC volume, which is Asia Pac volume, led by India and NSE, rising sharply through 2024 from 2021, and then a major decline through 25. That's not a typo. That's the volatility inherent in a transaction fee dependent model. Why the decline? A regulatory ceiling. If you remember, SEBI has tightened index derivatives rule specifically to curb speculative retail activity, and participation and turnover have already moderated as a result of this regulatory activity. That's a direct risk to lower volumes and lower premium turnover going forward. And third, a competitive threat. BSE is actively gaining a index option share, sitting at roughly 25% year-to-date premium share in that segment. And NCDX is also preparing to enter the equity, cash, and derivatives markets in the next 1 year itself. So the structurally opportunity remains real, but the growth engine that drove NSE historically is facing headwinds on three fronts simultaneously: a mixed concentration, a regulation, and third one is a competition. So let's bring all this together into a final score. On the issue pillar, NSE scores 1.5 star. On the company pillar, NSE scores 1.75 stars. And the total IPO rating NSE gets is 3.25 out of 5 stars, which means here is the headline takeaway from this, right? Only at a lower valuation within a narrow range, which means the final pricing needs to be land near 1600, not above it. This is genuinely a strong institution, a completely debt-free, dominant market share, best in class margin, but the growth story has real question marks, and the valuation needs to reflect that. A great business, but the price has to be right. So now let's flip to a very different kind of company, a Milky Mist. Our second case study is a Milky Mist Dairy Food Limited, a high growth, value added dairy business. This is a very different story from NSE. Here, growth, quality, leverage, and governance matter just as much as the brand itself. The key question for this one is the growth strong enough and durable enough to justify the IPO valuation. So let's look at the number. So if we look at the issue structure, the issue size is around 1500 crore, split between 1400 crore fresh issue and 125 crore offer for sale. Note that in contrast to NSE, here this one 92% is fresh issue, meaning most of the money actually goes into the company and not to selling shareholders. The price band is 133 to 140. On the face value of 2, the book running or BRLM managers are JM Financials, Axis Capital, and IFL. All are tier 1 names. Post issue, the promoters holding would remain closer to 80%. And at the upper brand, a very high level of continued alignment. The anchor book raised at 465 crore across 19 investors. That includes institutions such as IFC, Nippon India Mutual Fund, and HDFC Mutual Fund, a genuinely credible institutional name. The post-issue market cap of a company would be closer to roughly 10,000 crores with a listing date of 18th August. On the surface, strong bankers, strong anchor book, deeper. So let's run the scorecard. I want to jump straight to the conclusion because it's a stark contrast to NSE. Milky Mist scores right? Avoid at the upper band due to a stretch valuation, corporate governance concerns, and structural concentration. On the issue pillar, 2.25 out of 2.5 stars. A strong marks across the board. Solid issue structure, tier 1 bankers, promoter holding well above 70%, a favorable use of proceed mix, out of which 44% will be utilized on capex, 35% will be used towards a debt repayment, and closer to 20% will be used for a general corporate purpose, with no money reserved for M&A activity, and genuinely a credible anchor book of 46% domestic mutual fund plus IFC and Temasek. But look at the company pillar, a just 0.75 out of 2.5 stars. And this is where the real story is. Promoter background gets a partial star, a clean legal record, but flag related party value transfer. Board independence gets essentially a 0 star. Reason, a freshly assembled independent board with no listed company oversight experience whatsoever. Auditors gets a partial star, a quarter star. For the last 3 consecutive years, a recurring CARO qualification, signaling an internal control maturity gap. So if you look at the financial statements, they score essentially a 0. Reasons, pre-IPO leverage of 3.5 times debt to equity, which breaches our threshold of 2x. And EBITDA margin sits below a 15% quality bar. And growth outlook gets a partial or quarter star. Reason being the farmer sourcing and cold chain logistics, which is an actual real mode, but it's a regional and completely operationally concentrated in Tamil Nadu only. So total 3 stars out of 5 stars. A solid structured issue sitting on top of company with real unresolved governance and leverage questions. So let's look at why. So this deserves our attention because it's a completely textbook example of what IPO readiness governance risk looks like. So the independent board, if you look at, right, was constituted very recently. Dr. Ratnam, the current existing CEO, joined only in March 2025. And the 3 other independent directors joined between March 25 and July 26, right? Meaning their tenure with the company is well under 2 years across the board. None of the 3 independent director has prior experience as an independent director of another listed company. The another director, Mr. Armugam, does have a listed company exposure because he is the founder or MD of a Banani Aman Sugar, which is an executive role and not independent oversight experience. On the auditor side, a VKS Iyer and Company, a regional non-big four firm, has flagged a recurring issues over 3 years running. Incomplete audit trails, a 22 crores of inventory discrepancy in 25, another 26 crore inventory discrepancy in 26, and the same pattern follows in the subsidiary as well. So to be fair, this is not a fraud finding. The statutory audit opinion itself carries a no qualification on the financial statement. But these are the process observations under a CARO and other regulation. But taken together, a regional auditors, 3 set years of unremedied control gaps or internal control gaps, and a board with a 0 independent audit oversight experience. This signals that financial control maturity has lagged the company's rapidly scaling. with revenue up 73% in just 2 years, which means the company is growing rapidly, but there is no internal control system to stop the leakage. So quickly through the numbers, revenue grew from 1800 crore in FY24 to 3100 crore in FY26. Genuinely strong growth of nearly 34% in the most recent year. EBITDA margins improved each year too, from 12% to 14%, but still below our 15% quality threshold. The ROE of 31% looks impressive, but it's materially leveragedly inflated. The cleaner metric, the return on capital employed, sits at just 12%. Cash flow from operations to EBITDA missed our 70% threshold in 2 out of 3 years, driven by rising working capital needs. And to debt equity, even after improving from 4 to 3.6 times, it remains well above our 2 times comfortable threshold. So real growth, real margin improvement, but built on a leverage, still maturing a financial control foundation. So now let's stick to the IPO investor dilemma. So this is a 2x2 grid that ties both case studies together perfectly. So great business plus attractive valuation, that's an definitely investment. A great business plus expensive valuation, that's a NSE sitting in the wait and watch quadrant. A weak business plus cheap valuation is a classic value trap. And a weak business plus expensive valuation, that's exactly where Milky Mist lands. Avoid. The lesson, the best IPO is not necessarily the company with the highest growth. Business quality and valuation have to be evaluated together, never one without the other. So let's close the analytical section with the actual formula for a long-term wealth creation. Higher ROE multiplied by the sustainable growth, multiplied by disciplined reinvestment, and multiplied by a reasonable entry price equals a long-term wealth creation. Remember, the compounding engine is the business itself. The IPO merely determines your entry point. Get the entry point wrong, and even a wonderful business can be a mediocre investment for years. Get it right, and time does the rest. So, to summarize in one line, read the DRHP, ask 3 questions, use a structured scorecard, and never confuse listing day noise with a long term value. So, I am Aditya Jadhav, the founder of Ganbaru Advisors. My contact details are already on a screen. So, if you like to reach out, thank you for all your time today. So, invest in knowledge, create wealth. So, now I'll open the floor for a question.